He pitched us in that $17 billion round, and I did a Zoom with him. And after the Zoom, I'm like, this doesn't make much sense, but I'll have my team do some work. We did some work and we sent him a 2-page deck. And we said, here are our recommendations for taking the next step. One was the formation of a board. The second was the creation of dual class stock. The third was some reps and warranties around affiliated transactions and related party transactions. And the person that worked there called us back and literally, I'm not kidding you, said, go fuck yourself. There was an article that appeared that said that the head of compliance at FTX was also the head of compliance at a poker site called Ultimate Bet, which in the 2010s did this exact thing, apparently. Some version of this where they went in and they looked at hole cards of poker players, and then a few employees inside the business would basically play against these folks, knowing what the hole cards were, ran this cheat, stole millions of dollars. Somehow that person found a way to be head of compliance at FTX.
Yeah.
10 years later. This happens in the public markets a lot as well. So like when you see heavily shorted names, or when you know that certain hedge funds are on the brink, other hedge funds will go in and essentially force a margin call and a stop out, because then it's what causes all of these runs. And if you look actually inside a GameStop, the reason why you got all this gamification in the GameStop equity and a bunch of these other names was in part because of this dynamic. Folks that are highly levered, folks that don't have the right matching of risk. And what happens is they're solvent but illiquid. And then if you run the instrument into the ground, they both become insolvent and illiquid all at the same time. To me, it seems the whole issue, if you come back, like what is the first string that you pulled that unraveled the sweater, was the fact that these tokens were created out of thin air. They had no meaningful value. Somebody prescribed a value, and all of a sudden, everybody else in the economy all of a sudden said, yeah, I'll take that as collateral. Look, you cannot do that in the regular world. I can't call JP Morgan and say, I've invented this thing, it's called a share in XYZ, and I'd like you to margin loan, give me a loan against it. I think the problem is bigger than FTX. And I'll say the uncomfortable part out loud, and nobody needs to necessarily comment if you don't want to. But there were an enormous number of venture firms that talked their way into just completely doing zero work here. I mean, and the tip of the spear is this thing. Well, who's the guy that works at Founders Fund? Buljar? Zebuljar? Delian, thank you. Yeah. That tweet that he had where he basically took the snapshot of the Sequoia transcript was one of the funniest things that I've ever seen. I mean, this was a $215 million decision, and Sequoia documented it and put it on their own website. And I think that's an example of something that was happening, which is people just looked the other way and didn't even want to do the layer of work. I just want to say the second uncomfortable thing out loud, which is there was a lot of venture firms in Silicon Valley in this period of both not doing any work or diligence who also took the extra step and actually created classes and would teach teams how to create these tokens. Okay, and those artifacts, those video links and artifacts are sometimes on their website. They're still on YouTube. They're inside of Twitter. And what these folks would do, and we talked about this, the game that they played was they would get a team, they would create a token, they would also buy equity at some crazy valuation. The equity was locked up, but the tokens were not. And then they would put them on an exchange and sell them to unsuspecting people, and they would be able to dump these tokens. And if you look inside of that trend, what you're going to see, and Brian just mentioned this, those were the sale of securities, except it was done in a completely unregulated way. So if the SEC is really, and the DOJ is really going to take this FTT token issue seriously and what happened to FTX, they're going to start to look at a bunch of other tokens and token sales, and you're going to end up looking at some very well-known venture firms inside of Silicon Valley. That token, guys, let's be honest, is not the only token that has been engineered by Silicon Valley venture firms. And it is also not the only token that's gone to zero that was engineered by Silicon Valley venture firms. There's videos today on some of the most well-known venture firm sites on how to do this. You know, my biggest purchase ever was Bitcoin in 2011. You know, I've bought a bunch of these tokens that have massively depreciated in value. I think lots of investors have. I kind of fell into it as well. Like, I thought, wow, this is incredible. I get to buy these tokens. They do all of this cool stuff. They represent all this value. And my experience has been the opposite of that. I've lost a lot of money in these things. And so, I really hope that regulators, not just obviously, I hope that regulators do the best they can to get investors' money back in FTX. But I really also hope they figure out all these other tokens as well, because you can just rank them in terms of market cap, start at the top and work your way down. And you will see that these were unregulated securities, Jason, that were manufactured and sold by our brethren. Citadel does this in the regulated market. That's what payment for order flow is. It's the ability to front run retail volume. And so, in dark pools, that is legal by the law in the United States. And that's what allows Citadel and, I think Jane Street and Susquehanna, all these folks basically run these dark pool exchanges for regulated securities like options and bonds and stocks. And they get this order flow and they front run it by a millisecond, and they just take small vig. I just think that there's these really strict walls and segregation, as you heard Brian talk about, when you have those businesses in these regulated markets. The problem here is that this is totally
Wild West,
unregulated, wild west. So who knows what's going on, really?